Japan's worst bond auction in years spurs global sell-off. Japan's bond traders just had a taste of what it's like when the nation's central bank and pension funds aren't there to support them. Bond futures tumbled by the most since 2016, triggering margin calls for investors after the worst 10-year debt auction in 3 years. Yields across the curve climbed, while the sell-off also spilled into the Treasury and European debt. Behind the sudden collapse lies the Bank of Japan's decision to potentially slash bond purchases in October. An announcement by the Government Pension Investment Fund is pivoting towards buying more foreign debt. All of a sudden, investors were left wondering what other changes are in store. The BOJ's operation change has a huge psychological impact, says a chief bond strategist in Tokyo. Investors are reluctant to buy, given the risk of the BOJ skipping a purchase. Futures of 10-year notes slid as much as 0.97 yen to 154. Auctions of the 10-year debt drew a bid-to-cover ratio. I don't even know what that is, but it's all right. Here's what's interesting. Japanese sovereign bonds are already reeling from September, where they lost 1.1% in the first monthly decline since April. The BOJ on Monday slashed purchase ranges for 4 major maturities and indicated it might stop buying debt of more than 25 years. Now, this is important. It also suggested it could skip buying operations as a need to steepen the yield curve. Now, check this out. Yields on the 10-year cash bond rose 5.5 basis points to a minus 0.16%. You hear that? Yields on the 10-year cash bond rose 5.5 basis points to a minus 0.16%. That's a 20% increase in yields. And what does that mean? You're still getting negative yields for 10 years, a significant negative yield. They also gained 5 basis points with treasuries with a comparable maturity. All right. The world's largest pension fund, which is GPIF, which again was the Government Pension Investment Fund for Japan. The world's largest pension fund said it will consider currency-hedged overseas bond holdings as similar to domestic debt instruments. This will allow GPIF to buy more foreign debt. So it's already close to 19% limit. So what do you think is going on here? So basically, the Japanese says we need to get longer yield bonds to have a higher yield, longer maturity bonds to have a higher yield than shorter ones. Thus, we are going to stop buying the longer maturity bonds. What does the lack of demand do? What does it do? It drops the price, which increases the yields in the bond market. So in this case, Japan is saying we are going to get out of the long bond. I mean, theoretically, they're saying that. The long bond. So we are going to drop our long bond demand. Thus, we're not going to buy them. We're not going to be in the market. When there's no buyers, there's no demand. When there's no demand, what happens to the price? It drops like a brick in water, and then the yields go up. In this case, they went up by 25% on the 10-year, yet it's still trading at negative territory. Interesting, huh? Now, on top of that, the largest investment fund in the world, which is Japanese pension fund, they are going to allow, they're going to buy more foreign debt. I wonder why they would do that. What could possibly be the case why they're going to buy more foreign debt? Well, because they're getting negative yields on long bonds in Japan, and what's the U.S. doing is at least they're getting the positive yields in the 10-year treasury at 1.6 right now. So the Japanese are saying, screw that. We're going to go from negative 20 basis point 10-year to 1.6 10-year. That's an increase of, I don't even know what that is, 25,000 times, something like that. I don't even know what is the increase in that. That's a huge increase. The yield from the negative 0.2% to positive 1.6%. But what will that do to U.S. bonds? Well, do you think they're just going to buy Germany bonds? No. Do you think they're going to buy Greece bonds? You think they're going to buy Chinese bonds? Nah. What are they going to buy? More government U.S. debt. More government demand for U.S. bonds. What's that going to do? It's going to increase the price and it's going to drop the yields. I would imagine this is going to drop the yields even further as this situates itself into our economy. So it'll be interesting to follow. No one knows, but it's interesting. So we'll see you next time.